Welcome back to the Deep Dive. Our mission today, well, it's a deep dive into uncertainty, specifically the economic reality we're all feeling here in late 2025. You've probably felt the financial squeeze, right? But what are the actual numbers telling us about this persistent price pressure? And crucially, why is the market reacting, well, reacting by pushing the price of good old gold near record highs? What's going on there?
We're diving into independent business research and market analysis today, focusing specifically on the precious metals angle and financial conditions as of, well, right now, October 2025. And what jumps out immediately is this real tension. You've got the Federal Reserve signaling rate cuts, suggesting things might ease up, but at the same time, you, the consumer, are still dealing with pretty stubborn inflation. And the market, it's responding with that classic flight to safety, which in this case means a really significant surge in gold prices.
Okay, let's unpack that tension. We need the latest data. I mean, beyond the headlines about gas prices jumping around again, let's look at the core, the bedrock. What's the latest snapshot for U.S. inflation?
Sure. So if we look at the U.S. Consumer Price Index, that's CPI, the main measure, the headline rate, as of August 2025, was sitting around 2.9%.
2.9%. Okay, not double digits, but...
Exactly. It's not catastrophically high on its own, but it's significant because it's the highest sustained increase we've seen since earlier this year. It shows the pressure just isn't really letting up.
Right, but the Fed often looks past that headline number, doesn't it? Because food and energy prices can swing so wildly. What about core inflation when you strip that volatility out?
Yes. And that's the figure that, well, policymakers probably worry about most. Core inflation, excluding food and energy, is still stubbornly high. It's around 3.1%.
3.1% core. Okay, so higher than the headline. What does that tell us?
That 3.1% is a signal, really. It tells us the upward pressure isn't just, a blip at the gas pump or a temporary issue with harvest. It suggests the problem is more embedded, maybe in services, maybe wages. It's sort of baked into the wider economy. It points to more sustained price increases.
So we have this sustained pressure. What are the specific things driving it? It sounds like it's more than just leftover pandemic demand issues.
Oh, it definitely is. It's a complex mix, actually.
Right.
One big structural factor comes straight from trade policy. These tariffs that have been imposed on various imports, they're acting like a kind of quiet tax. They directly push up prices on consumer goods, things like clothing, some electronics, transportation-related products.
So the base cost is higher before it even gets to the store shelf?
Precisely. Tariffs give prices an upward nudge right from the start.
Okay, tariffs are a structural push. What about the day-to-day stuff everyone feels more directly? The volatility?
Well, on that front, gasoline prices have been, frankly, all over the place, really volatile. And that frequently throws the overall cost of living out of whack. And then there are the basics, supermarket food prices just keep climbing. That relentless upward trend really strains family budgets.
Any relief anywhere?
We did see a little bit of good news. Rents showed some signs of easing recently, but honestly, that single point of relief hasn't been nearly enough to offset the pressure everywhere else, especially in essential categories. It's compounded pressure.
Okay, so this brings us to the Federal Reserve. We've got core inflation running over 3%, yet back in September 2025, they actually cut interest rates. Doesn't that send a bit of a mixed signal? Like maybe they're prioritizing something else over hitting that 2% inflation target right now?
That's exactly the question the market is grappling with. Yes, the Fed did respond, citing concerns about broader economic softening. They cut the federal funds target range down to 4.00%, 4.25%, and they even projected more rate cuts coming, possibly into 2026.
But their official long-term target for inflation is 2%, and they're cutting rates when core inflation is clearly running hotter at 3.1%. What's the implication of that specific gap, that 1.1% difference?
Well, the implication is that the Fed is caught in a really tough balancing act. They're weighing the risk of inflation staying too high against the risk of maybe tipping the economy into a recession. By cutting rates, they're sort of implicitly signaling that maybe their bigger worry in the near term is keeping economic growth stable. It's just proven really, really hard to get inflation back down to that 2% mark. And the fact that it's still difficult after all this time and policy changes shows you the deep challenge they face. They're almost saying, look, maybe we have to live with slightly higher inflation for a bit if it avoids a really sharp downturn.
And while the Fed is juggling these big macro risks, you, our listener, are managing your own budget. Let's talk about the immediate impact of the sustained 3% pressure. It's that constant shrinking of your dollar's value, isn't it?
It is. It's like an insidious tax on your savings and your purchasing power. The research gives some very real examples. Over the last few years, essentials like groceries, gas, and especially healthcare costs, they've all become noticeably more expensive. Every dollar you hold just buys a little bit less. And if your income isn't keeping up with 3% core inflation, well, you're effectively getting a pay cut in real terms.
And it's clear this financial pain isn't spread evenly, right? Who's really feeling the brunt of this, according to the research?
Yeah, the strain is definitely felt most acutely by lower-income households. Their budget structure is just different. They spend a much, much larger share of their total income on those essentials that are seeing the highest inflation: food, housing, basic transport. So when those costs go up, there's really no cushion. It forces incredibly difficult choices between necessities right away.
Unlike higher income groups.
Exactly. Higher income groups often have more flexibility. Maybe their assets or income streams are less sensitive to these immediate price hikes. They might feel it, but it's not usually forcing those same kinds of trade-offs.
Let's focus specifically on retirees for a moment, especially those on fixed incomes. Their vulnerability to this kind of persistent inflation must be huge.
Absolutely. For retirees who depend on, say, a fixed pension or savings that don't automatically adjust for inflation, they face this risk of their living standards just gradually eroding over time, and it can be significant.
Even with things like Social Security adjustments.
Well, yes, Social Security and some government pensions do have cost of living adjustments, CLAs, which help offset some of it. But many private pensions or fixed income retirement plans just don't have that built-in protection. Their retirement planning was probably based on expecting lower, more stable inflation. This sustained 3% rate really challenges that long-term security they planned for.
Okay, so this widespread financial erosion combined with the Fed's kind of complex policy response, it brings us back to the market's reaction. Gold, the ancient asset, the classic inflation hedge. Why gold? What makes it the go-to safe haven in times like these?
Gold's traditional role is pretty straightforward, really. It's seen as a reliable store of value when confidence in fiat currency, regular government-issued money like the dollar, starts to fade. When the purchasing power of your dollar is shrinking by 3% every year, some investors naturally turn to tangible assets, things they can hold, things that aren't just paper promises, to try and preserve their wealth. Gold basically acts as a kind of barometer for distrust in currency stability.
But hang on, some people argue gold is just another volatile asset now, maybe like crypto, given how much its price can swing. Why do the sources still treat it as this primary hedge against inflation?
That's a fair point. It certainly shows volatility. But the sources we looked at stress that its recent big climb seems fundamentally rooted in genuine hedging demand, not just pure speculation. And the most dramatic data point really backs this up. In early October 2025, just recently, gold prices hit near record highs. They are approaching a really staggering $4,000 an ounce.
No.
That kind of valuation suggests a deep, broad market consensus, a belief that current financial conditions, specifically this mix of high inflation plus loosening monetary policy, justify a massive shift into non-fiat assets.
Approaching $4,000 an ounce, that's huge. What specific factors are pushing it that high right now? It can't just be the 2.9% CPI number alone.
No, you're right. It's really a convergence of several major drivers. First, absolutely, the sustained inflation we've been talking about. That's key. Second, the Federal Reserve's policy moves. The rate cuts implicitly signal they might tolerate higher inflation, which tends to weaken the dollar and make gold more attractive. And third, and this is critical, there's just a lot of generalized uncertainty out there. Global economic worries, geopolitical tensions, all that creates a significant risk premium that gets baked into the gold price. Investors are essentially buying stability or perceived stability, and they're willing to pay a very high price for it right now.
And how does gold performance stack up against other traditional assets in this environment, like stocks and bonds?
Well, we're seeing increased volatility pretty much everywhere else. Bonds tend to suffer because inflation eats away at the value of those future fixed payments, making them less appealing. Stocks face headwinds too, rising costs for companies, potentially tighter budgets for consumers impacting sales. Gold, on the other hand, often gains appeal as a diversifier, precisely because its value isn't directly tied to corporate profits or government debt in the same way. It's seen as a more fundamental hedge against broader financial stress.
Let's loop back quickly and connect that trade policy point directly to the prices people are seeing. You mentioned tariffs earlier as a structural driver. Can you flesh that out a bit more? How does that specific policy feed into that stubborn core inflation?
Sure. Those tariffs on a whole range of imported goods, they act as an ongoing cost pusher. It's not a one-off shock. It's a persistent policy choice that raises the cost of inputs and finished products day after day. The sources specifically highlight how this contributes directly to price increases in categories like clothing, electronics, and transportation-related products. And these are all things that feed straight into that sticky 3.1% core CPI figure we discussed. So, in a way, it's an inflationary pressure that policymakers kind of layered on themselves.
Okay. So we've got entrenched inflation, a Fed cutting rates anyway, and gold prices signaling some serious economic anxiety. What's the official forecast then? What are policymakers telling you, the listener, to expect moving forward?
The official economic projections, the consensus view from policymakers, generally suggest a path of moderate economic growth. And alongside that, a gradual easing of inflation over the next several years. That's the base case they seem to be operating under. They expect these pressures to slowly fade.
But expectations aren't guarantees, right? What risks are market watchers still keeping a close eye on? Things that could derail that moderate projection.
Absolutely. Vigilance is key. Market participants and policymakers are particularly watching out for two major risks that could really change the picture. First, any potential new supply chain disruptions. We saw how damaging those were before. They could quickly hike goods prices again. Second, any unexpected shifts in consumer demand. If demand suddenly surges in certain areas, it could accelerate price growth faster than the Fed can react. Those are the kind of potential triggers for inflation spiking again.
Okay, so let's try to summarize the core findings from this deep dive for you listening. Inflation is proving persistent. We're seeing a 2.9% headline rate, but maybe more importantly, a stubborn 3.1% core rate. This seems driven by structural costs, things like tariffs, but also energy volatility. And this relentless pressure is eroding your purchasing power, hitting lower-income households and retirees on fixed incomes the hardest.
And critically, the market's reaction to all this uncertainty, especially this unusual combination of sticky core inflation and Fed rate cuts, has sent gold soaring towards $4,000 an ounce. These developments really underscore why keeping a close eye on those inflation indicators and what the central banks are doing is just so essential for thinking about long-term financial stability.
So here's a final thought to leave you with. If that traditional relationship really holds true, that gold acts as a direct response to weakening currency, to diminishing purchasing power, then what does that $4,000 per ounce price point truly signal about the market's deep, long-term confidence in the fundamental value of the dollar? It raises a pretty important question for you to consider, especially as you watch the next inflation numbers roll in. And as this debate continues over whether that gold price reflects a smart hedge or maybe just hysteria.